We became the team that did international investment into the UK.
Working from home, that must make an enormous difference.
The US actually recovered quite quickly. We haven't.
If we want to move to the next stage of development, our economy has to
Welcome to Talking Markets. I'm Michael Wilson and I'm joined by my good friend David Buik. David,
greetings, kind sir.
Welcome to this edition. And I'm very pleased to see we're joined by James Max now. A CV, it's a bit too much, isn't it, really? But let's just start with broadcaster, journalist. Now, but there's a lot more to you, and this is really my first sort of double question, really. Why did you leave being a city person? And why did you concentrate on property?
Well, I actually started in property and I trained as a surveyor after I left university. I went to university to do a property degree, so land management at Reading, which has nothing to do with land or managing and everything to do with real estate. And I qualified at a firm that's now called Cushman & Wakefield, was DTZ at the time, and they're a big property advisor. And I did international investment into the UK, and as a result of doing that for 7 or so years, a knock at the door, and Morgan Stanley came along and said, look, we'd like somebody who's a real estate expert. Can you, would you consider joining? And after God knows how many interviews on however many continents, they agreed that somebody who was not perhaps formally trained in the world of investment banking should be taken into their fold.
How did you find that then?
Well, I think it's because I was involved in a niche of the market, but it was a niche of the market that was really taking off, and we became the team that did international investment into the UK. We bought a lot of buildings for overseas investors, mostly German funds, and that got the attention of the Americans, who were beginning to think at the end of the 90s that actually they should have a presence in the UK, not only for investment banking purposes, but also for real assets through their real estate and private equity funds and all that sort of business. So I went to Morgan Stanley and I was involved in things like the IPO of Canary Wharf Group and the securitization of Broadgate for British Land and a whole load of advisory transactions, and also some
stuff
work
for Webb and Knapp as well, presumably amongst that lot.
All sorts of things,
yeah.
And lots of different transactions, and that also gave me a lot of exposure to the private equity firms. One of them came knocking on the door and said, would you like to come and head up our UK part of the business? And I said, okay, because investment banks were about to have a shed. If you have a look back at the dot-com bubble when it burst, basically anybody who hadn't been to a business school and didn't tick the boxes of traditional investment banking stock, you were kind of at risk, and a lot of my friends and colleagues did end up getting fired or moved on or whatever. So private equity came along, knocked on the door, and I thought that's an interesting idea. And then long and short of it was we came to the end of the first fund, my boss left, I couldn't join in because of the conflict agreements and the contracts. I didn't particularly like the new management, and I had to go and do something very different, and that ended up in telly.
Well, that's tremendous. Now, reverting back to property for the time being, because I think this is fascinating. I mean, you're lucky enough to be young enough never to have been considered a baby boomer.
No, indeed not.
No. Give us a thumbnail sketch of how the property market, both commercially and domestically, has changed during the course of the last 30 years.
Well, I suppose the biggest change for commercial real estate was the introduction of a whole load of changes in terms of how property was taxed, and particularly in the 80s and then in the 90s that we saw significant investment from overseas investors. And I suppose the big waves, we saw the Scandis and we saw Japanese investors in the 80s. They all got their fingers burnt quite badly, and then the German funds came back in the sort of early mid-90s. They made a big play for real estate assets as a whole, but then what happened was that debt became much more available, markets became much more fluid, and so the private equity firms came along and realised that there was a massive disconnect between the listed property sector, and there still is a disconnect, by the way. So there's a massive discount, if you like, to net asset value on the listed sector, whereas the private sector was mostly dominated by very wealthy individuals. And of course, even if you're the wealthiest person on earth, you can't afford to buy that many big buildings, whereas private equity can. So private equity started to realise that there was a disconnect in the market. And then with things like securitization and different ways of financing it, there were more efficient ways that you could make it work, and better asset management and better ways of value assessment. And so we saw the internationalization of the market. With the internationalisation of the market also came a whole slew of people who then came to live and work in the UK. Whether it was part of, being part of the European Union or not, I think is kind of irrelevant. But London was seen as a destination. If you remember trying to go out for any kind of dinner or lunch or anything in the 80s, 90s, London was not a great destination for it. Why? Because it was old-fashioned, it was a bit fusty, it was dominated by, gentlemen's clubs, and that was kind of it, all pubs. And then what we saw was this revolution started to happen in terms of London turning itself from a big national city to an international global city. And that meant a huge opportunity for property development, perhaps Canary Wharf, the best example.
Yeah.
But then we saw a change in our retail, we saw changes in laws and legislation that meant that shops could open longer and trade differently. We saw shopping centres arrive in all sorts of shapes and different forms. We saw big box retail, we saw huge and massive development and changes in the use classes order that meant that people could invest and change real estate and reinvent it. And it was seen as a sector that provided a huge amount of potential return. That combined with the wall of equity, the wall of debt, meant that commercial market moved on. What also happened in the residential market is that you have to look back at mortgages, interest rates, where they were in the early 90s. I think when I first got a mortgage, I started work. Property prices were very low because they were a function of earnings multiple. And property wasn't seen as that sort of great investment. Yes, they'd gone up, but it wasn't seen as the thing that you must have, in the same way that it took a long time for the Thatcher changes of everybody must buy their home, everybody must be a homeowner, to really come into the market, and for products, particularly debt products, to allow people to do that. So the 90s saw that big change.
Well, also, even my generation going before that, the late 70s and 80s, I mean, I needed £5,000 extra because the most you could borrow was £30,000. And I bought a house in Islington and I was £5,000 short. So I went to a friend of mine who used to work at Warburg's, was at the Royal Trust Company of Canada. And I said, I need the £5,000, Bob. And he looked at me and he said, 22%. And I said to him, using some Anglo-Saxon language as well, you use your... And he said, you know damn well that you'll get a bonus that will be able to sort that out within a year. Now, either sign here or get out. The fact remains was that we had assets of property going up much higher than interest rates, because that has disappeared now, or is it just slightly changed, James?
Well, I think it's just slightly changed in the short term because we've got such big economic problems. And the huge swell of money, if you like, to buy houses, to buy homes, to buy your own home just isn't there. The debt products. Since the financial crash, we've seen a whole range of changes to the debt products and the rules applicable to people, which in my view are nonsensical. We've also got a Bank of England that doesn't seem to connect interest rate policy with economics. And we've got the aspiration has gone for a while. Of course, people would love to own their own homes, but the rental market has improved substantially. People are more sort of fluid, that attention, if you like, to I must get on the housing ladder. And also, because stamp duty has interrupted the market and it's become a tax on capital, and you also have a sort of lesser effect of the capital gain tax-free element of house ownership and property ownership that doesn't seem to be quite so prevalent.
And the incomes are not there either.
Correct.
To support that. I mean, that's, to me, the key thing is that people's incomes don't, Michael, seem to be going up.
Well, they haven't gone up as much, and that's partly because, again, you bring back the great swathe of immigration that we've seen. Immigration has done many great things for this nation. I probably wouldn't be here if it wasn't because of that a few generations back. But you also have a look at what that's done to wages. Now, wages have been interrupted by a huge supply of labour, particularly on lower amounts of sort of capital. But then we've also seen changes in the way that markets operate and changes in the way that we have to, I suppose, price these things into the marketplace.
Yeah.
And as soon as you have that in any shape or form, then it means that I suppose the markets aren't working effectively. And markets aren't working effectively because we've got a misunderstanding of that basic economic policy and a misunderstanding of what people genuinely need to be able to buy and sell their homes, combined with the fact that, I suppose if you've got that many people coming in, the net migration, 1.4 million people coming into the UK, 700,000 net, that's a big problem.
What does the what appears to me at least, and again things may row back slightly, but working from home, that must make an enormous difference, not only to the commercial sector but also to the housing sector as well. Or is that a silly question? I mean, what do you think?
I think working from home has a very significant impact in terms of how we use space. Does it mean that the office is redundant? No. Does it mean that firms have worked out how to make it work for them? Also, no. But if you have a look back in the day when we started work and you went to the office and it really was a 9 till 5 or longer endeavour, and you had to be seen in the office. I mean, you had to show your face, you had to be there. Technology has changed all of that. And I suppose to a smaller extent, I used to work in a business that required international travel. So you weren't in the office all the time and you were effectively working from home, or you're working in various different places. And I think we're just seeing a manifest of that you don't need to be there all the time. But in fact, effective working from home is down to management. So if you have good management, and they understand how your team works and they understand how you work, and it means that you're very, very effective in terms of how you operate as people and teams, then it can be very effective, and that means reconfiguration of the workspace, much more collaborative space, meeting rooms. You don't need to have a fixed desk. I mean, what do people use fixed desks for? To store their shoes. I mean, it's just unbelievable. People just leave all their gunk and rubbish there, and in fact it's just like a home because they can't be bothered to clean up after themselves. And in fact, you can be much more efficient with your space, but also it means that people can live a little bit further away. They can have a better work-life balance. Yeah. And also it means that you lose less time, if you manage it well, to people, the washing machine's broken, the boiler's broken, I need somebody there, I need to do something. Well, all of those things can be managed far better if you have good work from home policies and good work-life balance, and people will be happier. So I think work from home is here to stay.
If from an investor's point of view, what difference does it make to the commercial sector, for example?
I think from the commercial sector, it means that a new build that is far more flexible, that means that you can have less space and use it better. So, for example, the fact that we used to have offices just sitting sort of vacant for 2 days a week.
Huge atriums, they've gone now.
Yeah, I mean, lots of space has changed. And if you have a look at the very best new designs, the central space is really important, but it doesn't mean huge atriums to show off. It means better circulation space to show that you're there. We've got many more multi-occupied buildings because people don't need their own front door in the same way. Buildings are better asset managed. We've got a lot more taller buildings. We've got suites of offices, all sorts of things which the US market had years ago. And then also you have a look at the space and the way it's designed. It's more homely, functional, funky, because you've got to persuade people in, which means that the food options, the leisure space, the mixing space, the other things that go on in the office, in the workplace, need to be far more compelling to get people out of their homes and back in. It shouldn't just be a sort of rather austere, nasty concrete block with a desk and a chair. You've got to have a lot more stuff, and tech needs to be good. Ability to communicate with your colleagues and all that sort of thing is so much more important. Meeting rooms much more prevalent. No longer a waste of space. Technology to be able to use, screens and interactive equipment with Zoom meetings and all that stuff, so much more important. And those buildings which are both accessible and adaptable, they're the ones that are going to have the value. The ones which are old-fashioned and frankly not nice to be in are going to be the ones that become obsolete.
Now, we need to go back to history a bit, because there's quite a bit of interesting history of the way things have happened in terms of financing. Going back to the late 70s, when we had the secondary banking crisis, when people like United Dominions Trust and Mercantile Credit, Dorney Day, Dalton Barton, Keyser Ullman, all got into a certain amount of trouble. They were all bailed out by the likes of Barclays and Lloyds, who bought some of them, and some lessons were learned. And then, of course, we go to 2008-9. To obviously the problems that were in the United States with the Freddie Macs and the Fannie Maes and all these sort of people, and the way that it was distributed small packages of selling stuff off, where the thing actually was hopelessly regulated. Your comments, James, on that, and whether you think the authorities now in the banking sector is strong enough to see something like that coming again?
Well, I think we can certainly look back at history and say that regulation failed us. Regulation failed the West, and it failed the international banking system.
Yeah.
I also think that the finger of blame was very successfully pointed at banks and bankers, because that was a useful thing to do at the time.
And a few people got paid a lot of money.
A few people got paid a lot of money, and they almost walked away, if you like, scot-free. They were never held accountable for their actions. So I think we have to learn that people in business, when they make a lot of money, should be held responsible for their actions. Does it mean that retrospectively you can go back and take money for bad business decisions? No. Because if people make bad business decisions, that, I'm afraid, is a fact of life. People make money, people lose money, people make good decisions, they make bad decisions. You can't hold people accountable for that. But I do think that we've got a problem with how we pay people and how we reward people. But I also think we've got a problem with politics and politicians. Their knowledge of the financial system and how it works is pretty woeful. Yeah. And I also think that politics and politicians were responsible for fueling particularly that debt bubble that then led to the financial crash. Why? Because in the dot-com boom bust, huge amounts of money were pumped into the American and the British financial systems through quantitative easing, printing of money. When you push money into a market like that, you are creating an asset bubble. And when you don't look at debt and equity in their respective risk profiles and ratios, then you end up with a problem. That if you start treating debt as something that is always going to be paid back because it's asset backed, well, that asset may change in value. And if you have poor understanding of value and you have poor understanding of price and value, which can be very different things, then it means that you're probably going to end up in a problem should the market turn. We also know that markets rely on liquidity and fluidity, and they also rely on buyers and sellers in order to make them work. It seems simple, but in effect, what happens when either the buyers go or the sellers go, that's when you create the problems. We saw it again during COVID, that we saw oil go down to zero. I mean, that's ridiculous, but when you can't store it, it becomes, it becomes an albatross. And so if you have something that becomes an economic albatross, then at some point that's going to, drop like a stone in value. We've seen it with crypto, we've seen it with everything. So when we look at prices, people like to look at smooth curves and they say, oh, the upward trend is this, oh, the downward trend is that. And that's a whole load of BS, because we know that prices generally don't move in those smooth curves. They move up and they down and they spike and they shock. So the lessons that have to be learned is that governments cannot just print money off the back of creating a solution just to solve our short-term needs without understanding the unintended consequence. That regulators need to understand how things work. And I do think that investors need to have a different relationship between their senior management and also the people who work within those businesses in terms of particularly incentivization.
Can I just chip in before Michael comes in? I want to just develop the subprime lending. A lot of regional banks disappeared, which was painful, but I think it was the right thing that actually happened to give them the focus. Also, what I found fascinating, and I couldn't really work it out, is that because of TARP, that system, T-A-R-P, and the Federal Reserve and the US Treasury Secretary at the time, Hank Paulson, the US actually recovered quite quickly. We haven't. Why?
That's a big question. It's a big question and maybe difficult answers. Look, I think first of all, the American market has done two things which we have not. The first is that they became energy self-sufficient. So if you have a look at their cost base and what they're based off, the fracking and the amount of ability to create energy at hugely efficient pricing has significantly helped the US. The second thing is technology. Have a look at the wealth created by technology firms. Yes, they had the dot-com bubble burst, but they also were the people who invented Alphabet, i.e. owned as Google, Meta, Apple, these companies that have, and many others that have gone on to create significant value within the economy. They've also driven, through Tesla and others, the electrification of the car market. So they've had alternatives in which they've been able to grow their economy. We, however, have forgotten how to reinvent and forgotten that, the most basic of all, I suppose, tenets of business is reinvent or die. And we haven't reinvented ourselves. We had a fantastic time. We reinvented ourselves in the 80s and the 90s and to an extent the early noughties. And then we forgot how to do it. And we forgot how to do it because we became obsessed by talking about Europe, talking about immigration, talking about social problems, talking about mental health. And we forgot that, yes, those things can be important, but actually what people do in their day-to-day, what companies do, and in particular what entrepreneurs do, is so vital in terms of creating wealth. Nobody got wealthy working for a cotton mill. It was the cotton mill owner who got wealthy. So where are our cotton mills of today? Where are the new businesses that are not just rinsing it out of corporate worlds internationally, which are doing fine, but where are the new businesses that are creating exponential amounts of value? They're far and few between, and even less so in Europe. So if anybody thinks that this is a Brexit thing, that's rubbish. It's nothing to do with it. It's to do with the fact that if we want to move to the next stage of development, our economy has to both adapt its financial services to adapt its tax system so that it is more competitive, and stop being jealous of those who do well and encourage them to do well and to be on our shores and to be in our universities and to go off and do things and to create and to invent and to basically rip up the rule book if we're going to move on.
James Max, it's been absolutely fascinating. Thanks very much indeed for joining us. It's been
couldn't be better. Really.
Thanks very much
many
indeed.
Doors. Bless you. Thank you so much.
That is Talking Markets, the end of this edition for the moment. Do join us next time.